All right, good afternoon. Welcome back here to Trader Minute. Great to have you aboard. It's been a boring week for the challenge in terms of just being in all cash, but historic week for the market in terms of what it's done. And yeah, I'm not too disappointed to be in all cash. And yeah, we'll see some nice opportunities emerge from this. It's not going to happen today. It's not going to happen Monday. But as early as middle next week, we could start to see some things shape up, given where some of the charts are. But that'd probably be the earliest there. The thing that would be the closest is a potential kind of whipsaw in the market vibe. We've already talked about what we would do with that. So, challenge going to go in the weekend. We're at what 6,500, a little over 6,500 in cash, and ready to strike when the signals emerge. But this has been a historic week for the market. And I don't say that lightly. Historic is a week that, from a trader standpoint, you'll probably never forget what happened and, more specifically, why it happened. There are a lot of past weeks in the market where, yeah, there have been big moves, but it's hard to remember why, what was going on. This is one that, if you followed even with half an eye open, it's memorable. And, with a very strong catalyst and with a very strong, deep drop. And so we could put it in that historical category. The weekly damage has been pretty insane. Here's an S&P chart, a weekly chart of the S&P for the last 10 years. Take a look at the drop this week. We have not had that big of drop on a percentage basis in 10 years. Just hasn't happened. You think about all the stuff the market's been through in 10 years. It has not fallen this much on a percentage basis in 10 years. Flash crash? Nope. Came close. Flash crash was close, but it decided to rally on the Friday into the close, and so didn't have this deep of a gash on a 1 week basis. But on a percentage basis, this is the worst pullback that the market has experienced in over 10 years. That's just a little bit mind-blowing. A little bit sobering in terms of, what the market condition really is. And if you take a look to find a week where the market performed worse, we have to go back to the flash crash. That's where we have to go. Or excuse me, the financial crisis. That's where we have to go. We have to go all the way back to the financial crisis to find a week that was this bad. And you heard me talk about this morning the lack of safe havens, the lack of, just absolute safety out there for investors. Take a look at gold this week. One of the worst weeks for gold historically. I think 7 years. I think it's been about 7 years since it's had this bad of a week. I think we have to go back to 2013, right here in 2013, where we saw some big gold drops. But that's pretty big, pretty damaging. Now, the move in the market is significantly greater. Gold, it's down 4% on the week. The market is, it is down significantly greater here. So it's one where the safe havens have not been there. There has been some talk about some of these stocks that were holding up well. This stock's holding up well. This stock's holding up well. Does that mean something? Clorox had been holding up incredibly well all week. Today, bye-bye. See ya. What about CME Group? It was holding up. This thing was on a gain on the week as of yesterday. Today, bye. What about who else can we put in this list? Let's put Netflix, which isn't as deep of a drop, but still going to end with a loss on the week. We are starting to see some of the outperformers, get their wings clipped. We have seen the Apples of the world roll over. We have seen the Microsofts of the world roll over. But some of these others that have been holding up have finally started to get clipped and see some pretty harsh selling. CBOE, this is one that was holding up phenomenally well this week so far. Just wasn't seeing the aggressive selling come into it. Then today, bye bye. They take it out and throw it on the trash pile. And so a lot of that going on, and I do think that lends itself for the market setting up for a bounce next week. That said, the overall damage that we see in the market is something that tells us what? It tells us the rebound is not going to be a V shape. We're not going to just see this sell off and then just boom, just rocket ship back higher, not without some sort of massive catalyst. And so, from a bullish standpoint, you're looking for higher lows to come in. From a bearish standpoint, you're looking for a strong rebound to sell into. We'll have been preparing some stuff on that here today that I'll share with you next week. But we will we'll be seeing some of those opportunities kind of emerge into the markets. But one of the big problems the market has right now is still the coronavirus element, where the number of cases continues to grow, and the number of areas outside of China where the coronavirus is continues to increase. And as long as that happens, the market is going to continue with some of its fear. And we'll see this continue to be a pretty hefty story out there. But the weekly damage is startling. The pace of movement in the market is just absolutely fantastic. You see, I have this zoomed in on. This is a 1 minute chart of the market today, and most of the time during this time of year, we average about 2,000 volume a minute on S&P futures. We're averaging almost 10,000 volume a minute today, almost 5 times the volume. And if you take a look at some of these candles, this candle here started at 28.53 and in 1 minute ended at 28.77. This is a 24-point candle. 24 points on the S&P on this candle alone. We've gone through periods where the market has traded for 2 months without that big of a candle on any single day. And we're seeing those candles in singular minutes. Since I started the video, big, massive volume uptick right here. This uptick, the move, is what, 28.95 to 29.25. That's a 30-point candle. That's a 30-point candle there. And we see the Fed come out with their statement, and we don't see that big of a candle come into play. But these upside candles, they're rivaled by the downside. I mean, you take a look at this move up right here where the market rallied 50 points. I mean, this is a 50-point rally in 1, 2, 3, 4, 5, 6, 7, 8 minutes. 50-point rally in 8 minutes, and 10 minutes later, bye-bye. It's gone. And so to look at something and to say, hey, you know what, this stock's outperforming, or this is this, or that is that, and to really kind of sink your teeth into it and say, well, let me go after it, the way things look can change very, very quickly. You take a company like Johnson & Johnson. This thing held up pretty well Monday, Tuesday, Wednesday. In fact, it was one that I was looking at. I'm like, yeah, it's selling off. But it's not selling off to a heavy degree the way the market is. Then the last 2 days, whoosh, flush. And so the market's in for more. The market's in for more damage. The market's in for more turmoil. The market's in for more unknown. And the market is in for more big rallies and big sells. And rallies and sells that within minutes are greater than what we see in normal market conditions happen over the course and span of days. And that continues to be the pace. It's a day trader's delight. It's been fun, doing some day trades. I haven't been sitting at the computer all day, every day, day trading, but I've had fun with a few day trades. But they can go against you very quickly as well. So really have to respect that pace of movement that is out there in the market. We are closing a month here in February. Oftentimes, we will see sell action into the end of a month, but that's not something I would bet on going into today. I don't think the monthly element's going to have anything to do with anything, but we could see some harsh sell into the close, simply based on the fact that the weekly performance is so bad, and investors are very worried about what the week could be here. Now I'm pulling up the news feed here, and this candle on this massive volume, this happened as the Fed's Jerome Powell, Fed chair, is talking about the economy and the coronavirus. And he did use the term risks when talking about the coronavirus and economic risks that it does pose, and basically saying the normal Fed stuff that they will act, appropriately, which is typical Fed speak. All right, typical Fed speak. So anyway, a lot more stocks going into the green, as we get into the close, even though the market's down, 60 points, 50 points here. That changes every other minute. But a lot more stocks in the green here today. The VIX up there at that 50 level to see a little bit of relief, bounce, rally from here Monday and Tuesday is kind of what I would expect to see. But it's not very cheap to play it. And the options, especially if you're looking at options, if you're looking at individual stocks and buying some stocks, there are just some interesting ones out there that you could pick on up if you're willing to hold them. That have some interesting candles, so things like a Chipotle here today, even the SPY. If you're in that blood running in the street category, and you're saying, all right, I've been patient all week, I haven't bought anything, all right, let me dip my toes in. There's a decent argument that can be made to dip your toes in here, but it is one where you do have to respect the downside risk, so it's not where I would jump in, with 2 feet here. Just yet, but I'll be dipping my toes in most likely a little bit into the close with some of my favorites, and kind of just seeing what next week brings and go from there. Thanks for hopping on. Thanks for being with us here at Trader Minute. Have yourself a fantastic weekend, and we'll talk to you Monday. Take care.